Hi, everybody. Welcome to Rod's office hours this evening. Um, where tonight, as always, I'm going to be giving practical observations from the industry, oil industry website insights. And tonight is very interesting. We're going to talk about well operations, which is, I believe, the key to success in the oil industry. And I want to share some of the lessons that I've learned over the years, and also some pretty good case studies. So we'll just get right into it because we got a bit to cover here. The key to profitability in the industry. Well, there's a secret to adding value, and in the industry, and the way the oil industry works upstream, you invest in exploring and developing drilling wells. And then you produce. And as you're producing something, that's adding value. And that's where your profitability is coming from, or your revenue. And then at the end, then you have to abandon. And we want to have a good decommissioning plan. We don't want any liabilities. We want to put it back the way we found it. That's our standard way. So really, there's three paths. We invest, then we produce, and then we abandon. And all of those, the costs, the inputs, and the outputs of that's the key to our profitability. So, and really, I really want to spend most of our time talking about this production part, because that's where most of a well's life is spent, in the production activity. And as you're producing, wells need maintenance. As they're operating, you have maintenance activities, and they're referred to as workovers or well interventions. And it's critical to understand what can be done in a workover or a well intervention that can maximize production, reserves, and ultimately value. So we're going to spend some time talking about that. First, a little bit about myself. My name is Rod Gibbons. I've been a petroleum engineer and entrepreneur in the oil industry for over 30 years now. Together with my wife, Willow, we make doing business in the industry more effective. And I've had the privilege of working in multiple environments, multiple countries, locations, and I'm still working in the industry. I hope to share some insights I've developed over the years that you may not hear in other places or come across in textbooks. So this is not a theoretical discussion. This is based on sort of experience. Feel free to ask questions as we go. Just use the Q&A in the webinar section there, and any questions you have, happy to hear them. So first of all, I'd like to talk about the life cycle of a well. And we're going to be focused primarily on wells. There's lots of other parts of the oil industry, but we're just going to look at upstream and wells and reservoirs and fields. So there's an ISO standard for well integrity. There's an API standard, but the ISO standard is 16530, and that talks about well integrity over the life of a well. And that is, so there's different phases. They classify different phases in a well's life. And so you got here basis of design, construction phase. So a lot of times I won't refer to drilling. I'll call it well construction, because it's really around constructing an asset is what you're doing. Sorry, one sec. And then once you have done well construction, so you can see there's sort of a bit of a dash line over here to the abandonment phase. Sometimes when you drill a well, it's not successful. not economic, and you go straight to abandonment. But hopefully you go into the operational phase. And this is, again, can last for years. And then the intervention phase, you see, now we're sort of reversing back and forth, where we have normal production operations. The intervention, think of it as maintenance. We go back and forth between operations and intervention in the life cycle, and then ultimately abandonment phase. So, and then as we operate, as we intervene, as we abandon wells, we're learning things about well construction techniques and about the reservoir and the fields in which we're operating. So all of these are very important. And I'm going to, and I see a direct analogy here with owning a car, because a car also has this almost exact same life cycle. So, and not a lot of people own wells, but lots of people are familiar with cars. So when we talk about a car, life expectancy, according to Consumer Reports, which is a magazine that reviews cars, the life expectancy for a typical car is 8 years or 200,000 miles, or about 300,000 kilometers. So that's the operational phase of a car's life, is expected to be 8 years. A typical well is, and again, it depends on the environment and the type of well, but on average, a well will last from 20 to 40 years is kind of the time frame. Whereas if you think on a car, that's something that lasts 8 to 10 years. A well, think on 20 to 40 wells, about 40 years. And again, it takes months to do well construction, 40 years to operate, and then weeks or months to abandon. So this life cycle, it looks like the same length of time, but this phase is a lot longer, and it's very similar to when a car is manufactured versus when it's in service. This operational intervention phase is quite a bit longer. So I do have an example of this. This well is in Pennsylvania, and it's called the McClintock 1 well. And so you see it's a pump jack. We've covered that in the past, and very, very sort of, I find it a scenic setting. This well was drilled in 1861. So it's the oldest producing well that's still on production after 165 years. So you can see there's still a very small flare, still on production. 1861, I said the sort of the average well life is 20 to 40 years. This is the extreme example, 165 years. We talked about, you see, so it's producing into a barrel. With each pump stroke, you get some more fluid out. You can see it's very, very low oil cut right now. It produces water, but it's still producing. It still produces oil. And so if you think about what we talked about a couple of weeks ago, in 1857 was when the first well was drilled in Oil Springs, Ontario. 1859 was the Drake well, in not too far from here. And it's actually the Drake Museums owns this well now. And they produce it and actually use it to the oil they sell to help fund the museum. So, but again, this is an extreme example. But if you look at profitability, if you had invested to drill a well in 1861 and you continue to produce oil for 165 years, that's a pretty good return on investment, I would imagine. So, but again, extreme case. Just go back to our life cycle. So, basis of design, construction. We got a little video going here, again, talking about our car example. This is, and I've sped this up so that we don't spend all evening looking at car manufacturing videos, because that's not the real point. But in the well construction phase, you can see there's a lot of equipment being used here. Same as Toyota or any car company, they invest heavily into their manufacturing process, their lean systems. There is a lot of high capital costs here in this construction phase. So there's a lot of time spent in basis of design and design to make sure you get this right. On the well side, for example, some mobile offshore drilling units can cost upwards of $1.5 million a day for their spread rate. So that is equivalent to about $1,000 a minute. So same way a car manufacturing facility, if it shuts down, it probably is very expensive there as well. On the drilling side, or well construction side, it's high capital cost. This is where you're investing in your business. And so you want to plan it so that it goes good. But this construction phase probably lasts a month or two. So, and when I say spread rate on a drilling rig, what I mean is it's the cost of the rig and the supply vessels, or the food, the people, is the total cost. So if you think of a car, what your spread rate, if you had a car payment of say $500 a month and your insurance was $200, your spread rate is $700. Like it's the total cost. So, but that's on a daily basis. So you want to make sure that runs efficiently, and it gets a lot of attention. Drilling rigs get a lot of attention. Car manufacturing plants, they get a lot of attention. So, but you don't spend a lot of time there. You spend a lot of money there. You don't spend a lot of time. Now we go ahead to the abandonment phase. And again, I'm using our car example here. They call it dismantling of a car. So, and then on the well side, that's equivalent to a service rig or a snubbing unit. What you're doing, and again, this is sped up again so that this is how it happens. Again, very skilled. They take that apart and put it in different piles and sort it. But where the abandonment phase is at the end of an asset life, it doesn't get a lot of attention from oil companies or from car companies. It's outsourced a lot of times. It still takes highly skilled work. You have to be very environmentally conscious, but the costs are tried to be as low as possible because you've done your investment, you've produced your product or used your car, and now it is basically cleanup time. So the goal is to do that as economically as possible. So well construction, high cost, short time frame. Abandonment. The pressure there is always short time frame and as economical as possible. That leaves our operational phase, where almost all of our value comes from. And again, I promise this is the last car video I have. So car working great, you get a warning signal. Same as we're in the operational phase here now. This lasts for years. You have a problem, you need to do maintenance. So we have the same sort of thing when we're operating wells. We have sensors, we keep track of how things are running. If it starts to run poorly, we get an indication and we try and we take action. We intervene, we do maintenance. And so how long your car lasts, how profitable your wells are, it does depend on your basis of your design and how you've constructed your asset. But it also depends on how you've operated it and how you've maintained it. And so we just go to focusing in on the operational phase, operations and intervention phase of an asset, of a well's life cycle. And this is a type curve from onshore type reservoir. So you do a fracture, and so this is production rate, and this is time on this axis. So, and this is a very typical curve, so a type curve. What you'll see is the well come out early in life, very high rate, because that reservoir has not been depleted yet. It's not been drawn down. You get a very high rate initial production rate. Great. It probably flows naturally under its own reservoir pressure. We covered that in a few sessions ago. Then, as the production starts to drop, sometimes wells start artificial lift, and we start to draw that down. The gray dash line here would be the natural flow decline curve. So it comes down a little bit harder. And the red line here, this dash line, is the minimum economic flow rate. So this is your economic cutoff. So like the well we saw, the McClintock well, it's not making very much oil a day, but it's enough for the museum to make some money. It's probably well past its economic limit, but they still keep it going because it's fun to do. But when we're in the business of making oil and gas, we need to add value and be paid for that value. So without artificial lift, time frame wise, P&A is plug and abandon. So we're plugging the well and then abandoning it so that the ground is put back to the way it was before. But with artificial lift, we keep producing out. This can be much longer. And so this can be the difference between 8 years and 25 years. How we operate, what's our operating philosophy? So this is a type curve, but it is not uncommon. So it is actually typical. Here is a decline curve for an oil well. You see the oil production rate? It came on at just under 700 barrels a day. And then and the production rate is dependent on the geology. It's dependent on how we've constructed the well, but it's going to decline over time. So this graph is actually cumulative production in millions of barrels. So as it produces out, and then this graph is versus time. So you can plot it either way, but you'll start out with an exponential decline. So it comes down fairly predictably over time. And then as it starts to decline down, at some point it's going to go harmonic. It doesn't actually go straight down to zero. It doesn't cross, because again, if we look at that McClintock well, there's still a bit of oil left. You're still, it's not a big tank. It is a rock matrix that you're sweeping oil or gas out of. And so it can go on for quite some time. Same here. Here's historical gas rates. This is doing 50 million a day, 60 million a day coming on it. And then this is the time in days. And you can see that the data points are fairly easy to plot and you can forecast out. And we've talked about how this recovery forecast becomes reserves when we look at our P10, P50, P90 numbers. we can actually book reserves to this and book value. Here's a couple more production curves. Jones Creek, Eldfisk. Again, these came on in the 1970s, so it's late 70s. 100,000 barrels a day. This one, 140,000 barrels a day. So this for a field. So individual wells, you can do it. And if you sum a bunch of wells together, they will also have the same type of curve. So you can see the blues are actual data points. And so, you have a big dip in something. It could be, you probably might have shut down for maintenance. Because again, we're in the operations phase, so we got to keep things maintained. So you can, and this black line, same as this black line, you can see it's got an exponential sort of curve fit to it, which you can use for forecasting, and it'll go harmonic at some point. So flatten out and kind of keep going. So, and this is 1975, this is 2005. So that's 30 years. So again, very typical. And just for fun, again, going back to our car analogy, this decline curve is actually not from the oil and gas industry. This is actually a 10-year depreciation on a car. So if you bought a car new at 100%, here's what it looks like at 8 years and then 10 years on the value of your car. So it's this is 25% of the value. It's also, and after 10 years, it also sort of flattens out. It never goes to zero, but it gets pretty uneconomic. So again, if you think of a oil well or oil field like you would think of it as a car, it's really good at the early years, and then it's got to settle into a certain method of operating. And so we'll take an analogy. Again, I go back to Consumer Reports, how to make your car perform better. So if I say car, think on well. Address problems quickly. Keep your car clean. Bottom line, choose a reliable brand and a proven model. Follow maintenance intervals and treat your car well. Life expectancy typical, 8 years or 200,000 miles, 300,000 kilometers. A well-maintained car can cover more than 1 million miles or 1.6 million kilometers. This is the importance of operating and maintaining your assets. Makes sense when it comes to cars. I think we can all sort of imagine that. When it comes to wells, think on maintenance has to be through well interventions and workovers. And we'll talk about that. So, well, that sounds pretty straightforward. I guess you would assume most companies do that. Some companies have different drivers. So this is from actual case. So here's an oil rate. This is back in 2007. Around 5,000 barrels a day, 5,500 barrels a day, initial production. Again, you see this classic sort of curve. This is a field in Southeast Asia. And production came down and got down to about 1,000 barrels a day, and which was getting pretty close to the economic limit. This was an FPSO. And so again, the engineers have taken this data, and fit a curve exponential decline to it. And said, okay, here's the forecast. So this was unnatural production. And here, the field was shut in. And it was shut in for almost 5 years. And a different operator took it over. And when a new company came in, took it over, they actually said, okay, we like this reservoir, but we don't like this decline. We're going to apply gas lift into this field. We're going to reactivate it. We're going to apply gas lift. It came on at about 2,500 barrels. And you can see actually the same sort of decline here, exponential. And then it's flattened out at 2,000 barrels a day. It was here. By applying an artificial lift method, a fresh set of eyes doubled the value at this point. So, and you can see, okay, there's a decline curve here, but actually, if you zoom in on their actual gas and oil production, this is zoomed into that well period. Here's 2,000 barrels a day, or 2 million scuffs in red. You can see this is from October 2015 to October 2016. They drew a decline curve through here because they had to, but this is flat. So you've gone from an asset that has been shut in and dormant to steadily making 2,000 barrels a day by a different view of how to operate. Think of buying a used car and fixing and making sure the maintenance is done and improving it. You can get a lot of value out of that. Types of trouble. So in oil and gas wells, you can have different sort of problems. Some are related to the reservoir, and some are related to the well bore. On the reservoir side, and this is another case study, by the way. This is from a peer-reviewed paper. So you can have depleted reservoir, or you can have mismanaged reservoir. And I say this is from a peer-reviewed paper because this is not my word. This is an admission from the operator that sometimes you have too big a pressure drop. Other times you get the pressure in the wrong place, or you get the water flood going in the wrong place. Question on well bore. So a well bore, when we talk about our gas field or our oil field, we've got the reservoir, which is formed under the ground, and a well bore is the well. So you can have problems out in the reservoir, or you can have problems basically inside the casing, and so such as mechanical failures. So something has gone wrong inside the tubing or casing, preventing or restricting flow. You can have a high water oil ratio. So when we talked about gas lift and artificial lift, sometimes you're making a lot more water than oil, and that is causing the wells to not flow. Or you can have sanding or scaling. The well starts producing a lot of sand because we're in a sandstone reservoir, carbonate reservoir. You get fines, you get material coming in and can plug up the well bore. The gas is still there. The gas is in the reservoir, but it can't get through the well to the well bore, the hole that's been drilled in the earth, because there's sand or dirt getting in the way. Or you can have scaling, and scaling can occur when you have different minerals combined together and they precipitate out and again cause a flow problem. So in this case study, blue is water production, green is oil production. This is from 1977 to 94 or 95, 1994. So you can see oil came on at 2,000 barrels a day and declined over the course of almost 20 years, which, well, that's pretty good. Down to, this is getting pretty close to zero. They identified these sort of issues, this sort of trouble. They came up with a bunch of different tools I call it to avoid waste. That's my title on it, because you've invested to access these resources, it would be a waste to abandon this and not recover it. But as you can see, so what did they do? What did they do? Again, the field was shut in 94. It wasn't until 2003 when it was reactivated. How? Mechanical failures, tubing replacements, sucker rod replacements, scaling and plugging. So different sorts of scale, same as what would form in your sink or in your shower. You get different scale. Yeah, acid wash and cleaning, high water oil ratio, plug back, reperforation. We've got some slides coming up on that. But basically, if you've got water deeper in your formation, set a mechanical plug there so it doesn't flow, but the oil or gas that's higher up actually flows. Sanding, frac pack and screens, sand control. Put a screen in there so that the sand can get produced into the well bore, into the well, and cause an issue. Severe damage. Some wells are really in bad shape. The casing could be bad. There could be integrity issues. Sidetrack them and go for new targets. And again, these are all great ideas, but this is not just ideas. This is what they did. And they reactivated the field and it came on almost at 4,000 barrels a day. After it had produced down to zero over 20 years and then stabilized out at around 1,000 barrels a day of oil production. And we're still going. Again, this is a case study. This is not me saying, hey, this is possible. This is actually what happened, what they do. So this is the value. This is where there's real value in operating gas wells and operating oil wells. But again, like your how you operate your car, if you want that to last, you need to have the proper tools and proper people. So we have a number of well intervention tools, and this equipment helps us maintain our wells. So we have wireline units, which is basically can be slick line or electric line, and slick line is like a piano wire that you can run tools in, cameras, that sort of stuff, to see what's going on in the well, to log the well. They call it logging, where you're getting electrical signals or different sensors to see what's happening in a well. Coil tubing. So you can see here's on land, and these can be on land or offshore. They're somewhat interchangeable. Coil tubing. Again, this is the well Christmas tree here, and the injector. This is what pushes the coil into the well, and the coil tubing is like so where slick line or wire line is like a fishing line where you can hang stuff off and run it in. Coiled tubing is like steel garden hose, where you're putting actual hose off of this reel. It goes in and gets pushed into the well. This gives you the advantage of you can pump down it, so you can pump different acids. You can circulate the well around. You can. It's really good for what slick line and wire line is a really versatile tool. Once the well angle starts to get horizontal, this is dependent on gravity feeding, dropping tools in. Coil tubing, you can push the tools, so you're able to push it into sort of high angle and deviated wells. But the big thing is you can pump water down it, you can pump acid down it. These things to clean the well. So there's the well itself, the tubing and the casing, and then there's also the formation where the perforations are, where that connects your well to your reservoir. This is a frac spread. So it's gotten not a great reputation over the last few years, but this is actually what when we say we're fracking a well. So we have this is a control room here where you're monitoring your rates and pressures of your fluids. You've got these silos, which typically filled of sand. And then all these trucks lined up here all have pumps on them. High pressure pumps. You'll pressure up water and sand, and you'll pump it down a well. And it can, if you have damage close to your wellbore or a tight reservoir, you can fracture the rock. You can crack it open. And then once you crack the rock open, you can place sand in there, and that stops it from closing back up and allows the rest of the reservoir connectivity into the well. And it's been used since, I think, the 1940s. It's just there's been some issues in the past, say, 20 years. Integrity issues, but this is still a good process, still works. Snubbing. When you have, is a bit more, if you need to pull tubing. If your problem is a little bit bigger than, because these things are all through tubing. You leave the Christmas tree on the well and you're going through the tubing. If you need to pull the tubing, because maybe it's the tubing itself is the issue. And again, tubing is the pipe where the reservoir fluids flow through. You can use a snubbing unit to pull the pipe out, or a service rig, which is a lot like a drilling rig. It pulls the pipe out, but it actually doesn't it doesn't construct the well. It just maintains it. So you can pull tubing out, you can pull sucker rods out for a pump jack, and change them out. So those two tools, really, really useful. And then this is exclusive for offshore, of course. This is a light intervention vessel. So this is basically a ship that's got a moon pool in the middle where you can run these sort of tools, this sort of equipment in subsea wells. So it has to be on a boat because you're in the ocean. But again, all of these tools are what help us add value in the operational phase. Just a quick slide on acceleration economics. So in the examples that I showed, the wells, the field was basically shut in and was finished. So restarting it, you're going to add reserves because this is gas production you would not, or oil production you would not have got if you hadn't taken those steps. Some of the times when you're doing a well intervention, you're not accessing new reserves, especially say you're cleaning a well bore. Lots of times you're not accessing new gas or new oil, but what you're doing, again, here's our decline curve. If you do an intervention, say by adding a bigger pump, you're accelerating that production. Production was 50 cubes a day here. Now it's 100 cubes. Well, but you see what happens is in that acceleration, I'm taking more oil out now at a higher rate, but my decline rate also gets steeper so that it's the same volume of oil. I'm just getting it sooner by what I'm doing. That can also be very economic. If $1 today is worth way more than $1 in 10 years. So you have to be careful with acceleration economics, because it's not adding new value, but it is bringing cash flow forward. So that can be very valuable. There's another way where interventions and well interventions typically an order of magnitude cheaper than drilling. So if it was $1.5 million a day for drilling, it would probably be $150,000 for intervention type work. Just as divided by 10, it's that sort of again, same as building a car versus repairing a car. It can be expensive. It can feel expensive, but compared to building a new one, it's can be quite economic. So there's a case for acceleration. Just want to put that in there. Another case study. Again, this is production. This is another way of sharing this. This is time on the bottom from 1960 to 2030, 2020. This was the cumulative production. This is how much production. So this is 8 million cubes. And over here is the production forecast. It came out at 1,000 cubes a day, and the cubic meter is about 6.3 barrels. So this is about 6 million barrels a day. No, sorry, 6,000 barrels a day. Still pretty good. 1960, 1970, 1980, we're at 20 years, 30 years. Okay, so you can see at 20 years, the production starts to drop off here. And lots of times wells are abandoned because they're uneconomic, not because they are out of useful life. You know, the equipment doesn't always fail. It's more, you know, the company was really liking this for 20 years. This starts to get a lot more work. Same as a car gets older, you have to do a lot more maintenance to make sure it's running good. So you can see again, here's a case, got down to 100 cubes a day, 600 barrels. That's pretty well the end of it. So in this case, if we were sitting here and it's 2020, and you like, would you sell this asset? A great time to sell it would be up here, because maybe people will pay for what they think is going to be this sort of decline. Out here, this is a tough asset to sell. There's basically no value left in it. It's worth basically nothing. You would have to pay probably abandonment liability to get rid of it. Because again, that's the risk of waiting. Again, same as if you're selling your car. If it's 12 years old and had a teenager driving it for the last 5 years, it's probably not worth a lot. And if you were a buyer, are you interested in this? Because, I mean, some of the positions in the oil and gas industry is business development, is evaluating, going into data rooms and evaluating this sort of thing. Oil companies can grow production through the bit, as they say, through exploration and drilling, or they can acquire production. They can buy it from someone else who's got it, or that is ready to get rid of a field. Well, what happened here? This was what they thought the reserves were going to be. This is the increase. Again, using interventions and maintenance, field was restarted, and at about 250 cubic meters a day, which is about 1,600 barrels a day, at $50 a barrel. That's about $2.4 million a month, or $29 million a year is what this asset is now generating, because of some maintenance that was put into it, some care that was put into it. That is, again, it's there. It is in the reservoir. There is wells in it. It just, again, takes a lot of review and looking through and seeing where the opportunities are. So I talk about buying and selling. Would you buy and sell assets? Well, so M&A is mergers and acquisitions. Sometimes it's ND, divestiture. So merging, two companies come together, acquiring a company, or acquiring assets, or divesting, selling assets. So what are some things? So there's a median price for an asset, and typically this is transaction multiples. So how they track this is looking at a company's or an asset's revenue. How much revenue does it make in a year? And then what is the for the value of the company, for an oil and gas company, what's a typical multiple? So again, it depends region to region where you are. So you can see here some stuff from this is Alberta. This is a 5 multiple, but this was back in the early 2010s when the oil price and gas price were going quite high. Historically, an asset would sell for 3 times revenue. It's like a 3 times multiple is the historic for oil or gas. And again, depending on where it is. And again, and there's strategic reasons. So this is a company can have a strategic reason for selling an asset. So for example, the price of oil, different companies have different break-even points based on what you can get for the product that they make. And so some that need a higher price may want to get rid of some assets that are high priced, or some others that are lower cost can stand to maybe acquire some higher price assets. So that makes a difference. But when we look at it from a technical point of view, we got the median price, minimal shut-in. Like if you want to get the price higher for something, why would you pay more? It doesn't have a lot of shut-ins, wells, high amount of economic upside, facility capacity, low operating expense. It's operated. Driving the price down, lots of shut-in wells. There's a low working interest. You don't have a lot of say in how it gets operated. Non-operated. Limited amount of upside. When we talk about amount of upside, a lot of it is through well interventions and workovers. Potentially infill drilling as well, but this is factors that the market doesn't like and factors that they do like. So again, this is in the industry, you're going to be looking for opportunities. So what are some of the challenges that we see? Technical challenges. Again, we talked about perforation and perforation damage, needing to clean that up. Talk about coning. So coning is, so here's the perforations, and you're perforated in the oil zone. Okay, that's great. Below you you got water, and above is gas. And whoever perforated this perforated it perfectly. All the perforations are in the oil zone. Well, when you start drawing the pressure down to produce that oil out of the well, you can, and this is make a cone. The water starts to go for that pressure drop as well, and you get water production. Or the gas, it also starts to move towards that pressure drop and starts to cone down. So you can have excess water production or excess gas production, even though you're operating entirely in the oil zone. A lot of times, if you try and produce a well at a very high rate, it will induce coning. So if you shut in, it can relax that cone, and that's a way to know if you're coning or not. So, but you could do a water shut off or change your producing philosophy here. Again, here's an image of water coning. So again, perforations in the oil, but the water starts moving up towards it. The primary pay or bypass pay. So here's a well log, and you can see here's a nice gas zone. Well, a lot of times when you get this log data as you're drilling and constructing a well, but what will happen is you'll produce a lower zone first, because it's much easier to plug off that lower zone and then move upwards than to go the opposite way. Or sometimes this might have seemed small when the primary target was deeper. So there's always a perforation opportunity or a water shutoff. Here's two zones, oil and water. And okay, can you shut off the water and just produce the oil? Scale, so you can get scale forming inside of tubing, restricting flow, or you can have some sort of a mechanical. This is a picture from a downhole camera, which you would run as part of an intervention. And you can see there's a piece of pipe that's actually taking up a lot of this cross-sectional area for flow. Bit of a case study. So this is a wellbore that has 3 zones. It had a lower zone that was logged wet and wasn't completed. Then a middle zone here that was perforated, and an upper zone that was also looking as good for gas. So it was perforated, and then was isolated behind packers and a sliding sleeve, so that this zone could be produced first, then this one second, because they were different zones. So again, wet zone not completed. After they drilled and ran this completion, initial production test, the zone watered out immediately. So it looked like it was very good on the logs, but for some reason, it watered out quite quickly. So a water shutoff was done. So a plug was put in the well and cement was put on the plug. And then we're moving up, and then this sleeve was opened so that this zone could produce. Production tested that zone, it watered out immediately. So you had a wet zone not completed, and then both of the zones above it, which looked on logs to be dry gas, watered out almost immediately. Well, so the conclusion was there was natural fractures in these 2 zones that were causing water to channel and watered out those 2 sands. So no further development recommended. Okay, that's subsequently a camera was run on slickline in this well, and you can see here's the water. So this is the bottom of the well. You know, the camera kind of goes down and orients itself, and here it goes. Now it's going through the sliding side door, and you can see there's some buildup of some solids here, and the water looks quite murky. So that was kind of an odd result. And then further down in the well, this is a picture, just a still picture. So you can see here's the well bore. Here was the bottom of the well. Here is what looks like drilling mud and pieces of rock or cement blocking the well. That was done past the sliding side door. And then here is, so the downhole camera got down into this region down here, and operations opened the tree valves, and you can see gas production coming past the camera. So kind of a wet gas coming by. And again, this was said to have watered out because of natural fractures. And so you can see the camera gets moved up a little bit. So it's sitting here. So there should be no gas coming from here. There's a plug in the well. So that was a very strange result. You're down past the productive zone here now. And then very shortly, you see the gas starts to dissipate a little bit. And what do we see? It's coming. Bear with me. Now you see it. You can see it coming here now. There is water. And water hits the camera. And then this is the image from then on. You can't, because the water is very messy and you can't see it. But running the camera down here, through here, found a lot of sort of drilling mud and cement. And then when turning the well on, the gas was supposed to be coming from here, but it was actually coming from down here, followed by a lot of water. So if you remember, I had said the theory was that this was natural fractures causing water to channel in, and that's what caused no further development in the area. This downhole camera actually showed the water was not coming from this zone. It could be coming from this zone or potentially from this lower zone that was logged wet. And due to a bad cement job, a bad plug, that's what was causing this actual watered out result. So this goes to show you have a theory, you get new data, and you learn something, and you don't know what you're going to learn until you actually get there and do it. So that's where the opportunity lies, is in that sort of area of yeah, there's a theory, but maybe there's an alternate explanation that can lead to redevelopment of gas and oil reserves. So opportunity. Again, I go back to this example. Well shut in, the field shut in, adding gas lift, gets it back on. So through interventions, through operating practices, you can increase recovery from assets anywhere in the world of any type. So this is a great way. If you're working for an oil company or you have plans to have your own oil company, you can add value for your company. It's through this sort of work. So again, an intervention, it's like getting a checkup on your car. A tune-up improves the performance. So again, the same way you have a car, you want to keep it clean, you want to maintain it, you want to keep it, operate it nicely. You do the same thing with your assets and you will get more value out of them. So how you operate makes a difference. How it's built, designed and built, absolutely. But where you can get a lot of value is in the operations phase and in the intervention phase. So I hope that you find this intriguing and want to learn more about interventions and the different techniques that can be done and the different tools, because that's where you can add a lot of value to companies' bottom line. So there's a world of opportunity. Yeah. Ask anyone who's bought a used car. Like, there's a world of opportunity out there. So thanks for your time. I hope you found this informative. You can check out the rest of our webinar series on our YouTube channel. It's the link is in the Q&A. And in the meantime, my name is Rod Gibbons, and I'll see you next time. Thanks a lot.